Topic introduces VaR mapping, a technique used to simplify the risk measurement process for complex portfolios. Mapping converts complicated financial instruments into combinations of standardized market risk factors that are easier to analyze within a value-at-risk framework. Instead of valuing every instrument individually under every possible market scenario, risk managers approximate portfolio behavior using representative benchmark assets or sensitivities. This process significantly reduces computational complexity while maintaining reasonable accuracy. VaR mapping is especially important for large portfolios containing thousands of positions across multiple asset classes. The program emphasizes that effective mapping allows institutions to estimate market risk efficiently while preserving the essential characteristics of portfolio exposures. The mapping process relies on identifying the key market variables driving asset price movements. These variables may include interest rates, equity prices, foreign exchange rates, commodity prices, or credit spreads. Once the relevant risk factors are identified, individual securities are associated with benchmark instruments that exhibit similar risk characteristics. The mapped instruments can then be analyzed using variance-covariance matrices, historical simulation, or other VaR methodologies. Mapping accuracy depends on how closely the benchmark instruments replicate the actual behavior of the original positions. Poor mapping choices may underestimate basis risk, which arises when the mapped benchmark fails to move consistently with the underlying security during periods of market stress. Topic also focuses specifically on mapping fixed income securities, which presents unique challenges because bond prices depend on multiple factors including maturity, coupon rate, duration, convexity, and yield curve movements. Fixed income mapping often simplifies these exposures by associating bonds with zero coupon equivalents or benchmark maturity buckets. Duration-based mapping is widely used because duration measures a bond's sensitivity to changes in interest rates. Risk managers may divide the yield curve into segments and assign each bond exposure to the most appropriate maturity category. This approach captures the primary interest rate risk drivers while avoiding the complexity of modeling every individual cash flow within a large bond portfolio. The program also explains that yield curve changes are rarely uniform across maturities. Consequently, mapping approaches must account for shifts in curve shape, including parallel shifts, steepening, flattening, and curvature changes. Principal component analysis, PCA, is often employed to simplify these dynamics by identifying a small number of dominant yield curve factors. Typically, the first few principal components explain most interest rate variation, allowing institutions to model fixed income risk more efficiently. Mapping fixed income securities to these underlying factors enables more accurate VaR estimation while reducing computational burden. The topic emphasizes that understanding term structure behavior is critical for effective fixed income risk management and hedging strategies. Topic also introduces stress testing as an essential complement to VaR models. While VaR estimates losses under normal market conditions at specified confidence levels, stress testing examines the effects of extreme but plausible scenarios. Historical crises, hypothetical shocks, and scenario analyses are commonly used to assess vulnerabilities that standard VaR models may overlook. Stress testing is particularly important because financial returns often exhibit fat tails, changing correlations, and liquidity disruptions during crises. Regulators and financial institutions rely on stress testing to evaluate capital adequacy, portfolio resilience, and systemic risk exposure. The program stresses that stress testing provides critical insight into catastrophic loss potential beyond ordinary statistical estimates. The topic also discusses performance benchmarks used to evaluate the effectiveness of VaR models and risk management systems. Benchmarking involves comparing a bank's VaR model with alternative methodologies or realized portfolio outcomes. Institutions may compare positional VaR against profit and loss-based VaR models or alternative volatility forecasting approaches, such as GRCH models. Effective benchmarking identifies whether a model is overly conservative or insufficiently responsive to market changes. However, benchmarking presents challenges because trading portfolios evolve continuously and no universally accepted correct model exists. The program highlights that benchmarking should be combined with backtesting, sensitivity analysis, and expert judgment to ensure comprehensive model validation. Another important topic is the mapping of derivative instruments. Derivatives often contain nonlinear payoff structures that complicate direct VaR estimation. Mapping techniques simplify derivatives by expressing their exposures in terms of underlying market risk factors and sensitivity measures such as delta, gamma, vega, and rho. Delta mapping approximates derivative price changes as linear functions of underlying asset movements and is commonly used for options with small price fluctuations. More sophisticated approaches may incorporate higher-order sensitivities to capture convexity and volatility effects. Effective derivative mapping allows institutions to integrate complex instruments into portfolio-wide risk measurement systems consistently and efficiently. Overall, topics emphasize that VaR mapping, stress testing, benchmarking, and derivative modeling are essential components of modern market risk management. Mapping techniques improve computational efficiency while preserving critical portfolio risk characteristics. Fixed income mapping and principal component analysis help institutions manage complex interest rate exposures, while derivative mapping translates nonlinear risks into measurable sensitivities. Stress testing and benchmarking provide additional safeguards against model weaknesses and unexpected market disruptions. Together, these methodologies create a more comprehensive and resilient risk management framework. The program demonstrates that successful market risk measurement requires balancing mathematical precision, practical implementation, and sound professional judgment under evolving market conditions.